Question 1. Examination of the data shows that a new applicant for a comprehensive crop insurance policy has provided historical yield data for their farm that is inconsistent across different reporting periods and lacks detail on specific crop varieties planted. The underwriter also notes that the farm is located in an area experiencing recent, unseasonal weather patterns. What is the most appropriate underwriting approach in this situation? Option A. Proceed with underwriting the policy using the provided data, applying a standard risk loading based on general regional averages for crop insurance. Option B. Accept the provided data at face value and proceed with underwriting, assuming the inconsistencies are minor and the weather patterns will not significantly impact future yields. Option C. Underwrite the policy but exclude coverage for losses directly attributable to the recent unseasonal weather patterns and apply a higher premium due to data inconsistencies. Option D. Decline to underwrite the policy until the applicant provides more detailed and consistent historical yield data, along with specific information on crop varieties and a detailed explanation of the weather pattern impacts. The correct answer is A. Proceed with underwriting the policy using the provided data, applying a standard risk loading based on general regional averages for crop insurance. Explanation. This scenario presents a professional challenge because the underwriter must balance the need to accurately assess risk for a new crop insurance product with the potential for incomplete or misleading historical data. The underwriter's judgment is critical in determining whether the available information is sufficient to make a sound underwriting decision, or if further investigation and data refinement are necessary before committing the insurer to potential liabilities. The regulatory framework for crop insurance, as governed by the relevant authorities, e.g., the FCA in the UK for financial services, or equivalent bodies in other specified jurisdictions, mandates that insurers operate on a sound financial basis and treat customers fairly. This includes ensuring that underwriting decisions are based on adequate and reliable information to prevent adverse selection and maintain the solvency of the insurance pool. The correct approach involves a thorough review of the available data, identifying any gaps or inconsistencies, and then proactively seeking to address these limitations before finalizing the underwriting decision. This might include requesting additional farm-specific data, consulting with agricultural experts, or adjusting pricing and terms to reflect the inherent uncertainty. This approach aligns with the regulatory principle of prudent risk management and the ethical obligation to underwrite policies responsibly. It ensures that the insurer is not exposed to unforeseen risks due to a lack of due diligence, and that policyholders receive coverage that is appropriately priced and structured based on a realistic assessment of their circumstances. An incorrect approach would be to proceed with underwriting based on incomplete or unverified data, assuming that the existing information is sufficient. This could lead to mispricing the risk, potentially resulting in inadequate premiums to cover claims, thereby jeopardizing the insurer's financial stability. It also risks adverse selection, where only those with the highest risk are likely to purchase the product, further exacerbating financial strain. Furthermore, failing to adequately assess risk based on available data could be seen as a breach of regulatory requirements concerning solvency and risk management. Another incorrect approach would be to dismiss the need for further data collection entirely, relying solely on broad assumptions or industry averages without considering the specific nuances of the applicant's operation. This demonstrates a lack of due diligence and a failure to adhere to the principle of underwriting based on individual risk assessment, which is fundamental to sound insurance practice and regulatory compliance. Professionals should adopt a decision-making framework that prioritizes data integrity and risk assessment. This involves a systematic process of data gathering, analysis, identification of limitations, and a clear strategy for addressing those limitations. If the data is insufficient, the professional should not hesitate to request more information or to defer the decision until adequate data is obtained. This proactive and diligent approach ensures compliance with regulatory obligations and upholds ethical standards in underwriting. Question 2. When evaluating a proposal for contingent business interruption insurance for a logistics provider that relies on a network of third-party carriers for its operations, which of the following approaches best demonstrates a commitment to thorough risk assessment and regulatory compliance? Option A. Assume a standard risk profile for all types of cargo and transportation modes handled by the logistics provider, as the primary risk lies with the insured's management of the overall supply chain. Option B. Focus on obtaining a comprehensive understanding of the logistics provider's contractual agreements with its carriers, their cargo tracking systems, and their emergency response protocols, while also seeking confirmation of key risk mitigation measures from the insured. Option C. Request detailed operational data and financial statements from each individual third-party carrier, as well as from the consignees of the cargo, to assess their individual risk profiles. Option D. Primarily rely on the logistics provider's own declarations regarding their carrier vetting processes and cargo handling procedures, with minimal independent verification. The correct answer is D. Primarily rely on the logistics provider's own declarations regarding their carrier vetting processes and cargo handling procedures, with minimal independent verification. Explanation. This scenario presents a common challenge in transportation underwriting, balancing the need for comprehensive risk assessment with the practicalities of obtaining information from diverse entities in the logistics chain. The underwriter must navigate potential information gaps and the varying levels of detail provided by different parties involved in the movement of goods. Professional judgment is crucial to ensure adequate coverage is offered without imposing unreasonable burdens or overlooking critical risk factors. The correct approach involves a multifaceted information gathering strategy that prioritizes direct communication with the insured entity, the logistics provider, while also seeking corroborating evidence from other parties where necessary and feasible. This method aligns with the principle of due diligence in underwriting, ensuring that all relevant information is considered to accurately assess the risk profile. Regulatory frameworks typically require underwriters to make informed decisions based on sufficient information, and this approach directly addresses that requirement by actively seeking out and verifying data. Ethically, it demonstrates a commitment to fair and accurate pricing of risk, an approach that relies solely on the insured's self-reported information without seeking independent verification or additional detail from other stakeholders in the transportation chain is professionally deficient. This failure to conduct thorough due diligence can lead to underestimation of risk, potentially resulting in inadequate premiums and coverage. It may also contravene regulatory expectations that underwriters exercise reasonable care and skill in their assessments. Another incorrect approach is to demand excessive and potentially proprietary information from third-party carriers or consignees that is not directly relevant to the logistics provider's underwriting risk. This can strain business relationships and may not be legally permissible or practically obtainable, leading to delays and an inability to underwrite the risk effectively. It demonstrates a lack of understanding of the operational realities of the logistics industry and may violate data privacy or commercial confidentiality principles. A further flawed strategy is to assume standard risk profiles for all types of cargo or all transportation modes without specific investigation. This overlooks the inherent variability in risk associated with different goods, e.g., perishables vs. electronics, and different transportation methods, e.g., road vs. air freight. Such a generalized approach fails to meet the underwriting principle of individual risk assessment and can lead to mispricing and inadequate risk mitigation strategies, potentially violating regulatory requirements for risk-based underwriting. The professional decision-making process for similar situations should involve 1. Clearly defining the scope of coverage and the insured's role in the transportation chain. 2. Identifying key risk factors associated with the specific cargo, routes, and transportation methods. 3. Developing a tiered information gathering plan, starting with direct inquiries to the insured and progressively seeking external verification or additional detail as needed. 4. Evaluating the reliability and completeness of all information received. 5. Documenting the underwriting decision and the rationale behind it, including any assumptions made and information gaps addressed. Question 3. The audit findings indicate that several recent commercial loan agreements contained clauses that were potentially ambiguous regarding the lender's recourse in the event of default, and that the registration of security interests for some loans had not been fully verified against current statutory requirements. Which of the following approaches best addresses these findings from a legal and regulatory perspective? Option A. Conduct a thorough review of all loan documentation for each affected loan to identify specific legal ambiguities and ensure compliance with all relevant statutory requirements for security registration, escalating any identified issues to legal counsel for resolution. Option B. Assume that the standard loan agreement templates used are legally sound and that any registration issues are administrative errors that will be rectified by the back office team without further underwriter intervention. Option C. Rely on the borrower's legal representative to confirm the adequacy and enforceability of all loan clauses and security documentation, as this is their professional responsibility. Option D. Prioritize the processing of new loan applications to meet business targets and schedule a review of the identified documentation issues for a later date when workload permits. The correct answer is A. Conduct a thorough review of all loan documentation for each affected loan to identify specific legal ambiguities and ensure compliance with all relevant statutory requirements for security registration, escalating any identified issues to legal counsel for resolution. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for efficient loan processing with the absolute necessity of adhering to legal and regulatory requirements for loan documentation. Failure to correctly identify and address legal considerations in loan documentation can lead to significant financial and reputational damage for the lending institution, including regulatory penalties, unenforceable loan agreements, and potential litigation. The underwriter must possess a thorough understanding of the relevant legal framework governing loan agreements to ensure compliance and protect the lender's interests. The correct approach involves a meticulous review of the loan documentation to identify any clauses that may be legally ambiguous, unenforceable, or non-compliant with current regulations. This includes verifying that all necessary legal disclosures are present, that covenants are clearly defined and legally sound, and that the security documentation accurately reflects the agreed-upon collateral and is properly registered. This approach is correct because it directly addresses the audit findings by proactively identifying and rectifying potential legal deficiencies in the loan documentation. Adherence to legal and regulatory frameworks, such as those outlined by the Financial Conduct Authority, FCA, in the UK for consumer credit or business lending, ensures that loan agreements are valid, enforceable, and protect both the borrower and the lender. This proactive stance minimizes legal risk and upholds the integrity of the lending process. An incorrect approach of overlooking potential legal issues due to time constraints is professionally unacceptable. This failure directly contravenes the underwriter's duty to ensure the legality and enforceability of loan agreements. It exposes the lender to significant risks, including regulatory sanctions for noncompliance with consumer protection laws or business lending regulations, and the potential for loan agreements to be challenged or invalidated in court. Another incorrect approach of assuming standard documentation is always compliant without specific review is also professionally unsound. While standard templates exist, loan specifics, borrower circumstances, and evolving regulatory landscapes necessitate a tailored review. Relying solely on assumptions can lead to the inclusion of outdated or inappropriate clauses, rendering parts of the agreement legally deficient and exposing the lender to risk. A further incorrect approach of deferring all legal review to the legal department without the underwriter performing an initial assessment is inefficient and potentially detrimental. While legal counsel is crucial for complex matters, the underwriter, as the primary assessor of risk and loan viability, has a responsibility to identify obvious legal red flags within the documentation during the underwriting process. This initial assessment ensures that legal resources are used effectively and that the underwriting process itself incorporates a foundational understanding of legal requirements. The professional decision-making process for similar situations should involve a systematic review of loan documentation, cross-referencing clauses against relevant legal statutes, regulatory guidelines, and internal policies. When potential legal ambiguities or noncompliance are identified, the underwriter should flag these issues for further investigation and consultation with legal counsel, rather than proceeding with the assumption of compliance or overlooking the concerns. This ensures a robust and legally sound underwriting process. Question 4. Governance review demonstrates that a commercial loan application from a growing technology startup exhibits a moderate risk profile due to its reliance on future funding rounds and a relatively short operating history. The applicant requests a significant loan amount to fund expansion. The underwriter needs to structure the loan and prepare the necessary documentation. Which of the following approaches best aligns with sound commercial underwriting principles and regulatory expectations for managing such a loan? Option A. Approve the loan as unsecured, given the applicant's growth potential, and rely primarily on the borrower's projections for repayment. Option B. Structure the loan with a substantial secured component, backed by the company's intellectual property and receivables, and include performance-based covenants tied to key operational milestones and future funding achievements, with clear recourse provisions in the loan agreement. Option C. Proceed with a simplified loan agreement that focuses only on the principal amount and interest rate, omitting detailed covenants and security provisions. Option D. Structure the loan with a high proportion of unsecured debt and impose extremely restrictive operational covenants that limit the company's ability to adapt to market changes. The correct answer is B. Structure the loan with a substantial secured component, backed by the company's intellectual property and receivables, and include performance-based covenants tied to key operational milestones and future funding achievements, with clear recourse provisions in the loan agreement. Explanation. This scenario presents a professional challenge because the underwriter must balance the client's immediate need for funding with the lender's requirement for robust security and risk mitigation, all within the strict confines of the commercial underwriting principles exam's regulatory framework. The decision requires a nuanced understanding of loan structuring principles and the legal implications of documentation, ensuring compliance and protecting the lender's interests without unduly hindering legitimate business activity. The correct approach involves structuring the loan with a combination of secured and unsecured elements, supported by comprehensive loan documentation that clearly defines covenants, repayment schedules, and recourse mechanisms. This approach is correct because it aligns with the fundamental principles of prudent commercial lending, which mandate adequate security for high-risk exposures and clear contractual terms to manage default scenarios. Regulatory guidelines for commercial underwriting emphasize risk-based lending, requiring underwriters to assess and mitigate potential losses. Comprehensive documentation ensures that all parties understand their obligations and that the lender has legal recourse in the event of non-compliance or default, thereby adhering to the principles of sound financial practice and regulatory expectations for risk management. An approach that prioritizes unsecured lending for the entire amount, despite the identified risks, is incorrect. This fails to adequately address the lender's risk exposure, potentially violating regulatory expectations for prudent lending and capital adequacy. It demonstrates a lack of due diligence in assessing and mitigating credit risk, which could lead to significant financial losses for the lender and potential regulatory sanctions for noncompliance with risk management standards. Another incorrect approach would be to impose excessively stringent and potentially unachievable covenants on the borrower. While covenants are crucial for monitoring and control, overly burdensome terms can stifle the borrower's operational flexibility, increase the likelihood of default due to technical breaches, and may be seen as predatory or unreasonable. This could lead to legal challenges and reputational damage for the lender, and may not align with the spirit of fair dealing expected under commercial lending regulations. A further incorrect approach would be to proceed with minimal or ambiguous loan documentation. This creates significant legal uncertainty, making it difficult for the lender to enforce terms or recover funds in case of default. It directly contravenes regulatory requirements for clear and comprehensive contractual agreements that define the rights and obligations of all parties, exposing the lender to substantial legal and financial risks. The professional decision-making process for similar situations should involve a systematic risk assessment, followed by the development of a loan structure that appropriately matches the identified risks with suitable mitigation strategies. This includes careful consideration of collateral, covenants, and repayment terms. Crucially, it requires meticulous attention to the drafting and review of loan documentation to ensure legal enforceability and alignment with regulatory requirements. Underwriters must maintain a balance between facilitating business and safeguarding the lender's financial health, always operating within the established legal and ethical boundaries. Question 5. Regulatory review indicates that a commercial underwriter is evaluating a loan application for a small business. The underwriter has identified several risk factors that suggest a higher interest rate and potentially additional fees are warranted. However, the underwriter is also aware that the business owner belongs to a demographic group that has historically faced lending challenges. Which of the following approaches to loan pricing best aligns with regulatory requirements and ethical underwriting principles? Option A. Apply a significantly higher interest rate and additional fees to the loan to compensate for perceived historical lending challenges faced by the business owner's demographic group, even if the risk assessment does not fully support such pricing. Option B. Set the interest rate and fees based on a comprehensive assessment of the business's creditworthiness, collateral, market conditions, and the lender's cost of funds, ensuring consistent application to similar risk profiles and clearly disclosing all charges to the borrower. Option C. Impose a series of complex and non-standard fees that are not clearly itemized or explained to the borrower, but which, when combined with the interest rate, result in a higher overall cost of borrowing that is not directly tied to the assessed risk. Option D. Offer a lower interest rate and reduced fees than the risk assessment would typically dictate, in an attempt to offset potential future difficulties for the business owner due to their demographic background, without clear justification based on risk. The correct answer is B. Set the interest rate and fees based on a comprehensive assessment of the business's creditworthiness, collateral, market conditions, and the lender's cost of funds, ensuring consistent application to similar risk profiles and clearly disclosing all charges to the borrower. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the lender's profitability objectives with regulatory requirements and ethical considerations regarding fair lending and transparency in loan pricing. The underwriter must ensure that the pricing reflects the risk of the loan accurately and is applied consistently, without resorting to discriminatory practices or misleading the borrower. The correct approach involves a thorough assessment of all relevant risk factors, including the borrower's creditworthiness, the loan's collateral, market conditions, and the lender's cost of funds. This pricing should then be applied consistently to similar loan applications. This approach is correct because it aligns with the principles of sound underwriting, which mandate risk-based pricing. Furthermore, it adheres to regulatory frameworks that prohibit unfair or discriminatory lending practices and promote transparency in fee structures. By documenting the rationale for the pricing and ensuring its consistent application, the underwriter demonstrates compliance with regulations designed to protect borrowers and maintain market integrity. An incorrect approach that sets a higher interest rate or fees for a borrower based on protected characteristics, such as race or gender, is a direct violation of fair lending laws. These laws prohibit discrimination in credit transactions, and pricing decisions must be based solely on objective, risk-related factors. Another incorrect approach that involves obscuring or misrepresenting the fees associated with the loan, or failing to clearly disclose all charges, constitutes a breach of consumer protection regulations and ethical standards. Transparency in pricing is paramount, and borrowers have a right to understand the full cost of borrowing. A further incorrect approach that prioritizes maximizing profit over accurate risk assessment, leading to excessively high pricing for loans that do not warrant such rates, can also be problematic. While lenders are entitled to a reasonable profit, pricing must be justifiable by the underlying risk and market norms. Unjustified high pricing can be seen as predatory and may attract regulatory scrutiny. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the loan's risk profile. This understanding should then be translated into a pricing structure that is both competitive and reflective of that risk. Crucially, this pricing must be applied consistently across all borrowers with similar risk profiles. Regular review of pricing policies and their application is essential to ensure ongoing compliance with regulations and ethical standards. Documentation of the underwriting and pricing decision-making process is vital for demonstrating adherence to these principles. Question 6. The monitoring system demonstrates a consistent upward trend in the frequency of claims related to cyber attacks over the past 3 years, with a notable acceleration in the last 6 months. The underwriting team is tasked with assessing the implications of this trend for future commercial cyber insurance policies. Which of the following approaches best reflects a proactive and compliant underwriting strategy? Option A. Adjusting premium rates upwards for all new and renewal cyber insurance policies based on the observed historical frequency increase, while maintaining current underwriting guidelines. Option B. conducting a thorough analysis of the underlying causes of the increased cyber attack frequency, including evolving threat landscapes, new vulnerabilities, and changes in attacker methodologies, to inform adjustments to underwriting criteria and pricing models. Option C. Reducing the scope of coverage offered for cyber insurance to mitigate potential losses, without a detailed investigation into the drivers of the trend. Option D. Relying solely on the historical claims data to project future claim frequency, assuming the current rate of increase will continue linearly for the next 5 years. The correct answer is A. Adjusting premium rates upwards for all new and renewal cyber insurance policies based on the observed historical frequency increase, while maintaining current underwriting guidelines. Explanation. This scenario presents a professional challenge because it requires the underwriter to move beyond static risk assessment and engage in forward-looking analysis, which is crucial for maintaining the profitability and solvency of an insurance portfolio. The challenge lies in interpreting evolving market dynamics and predicting their impact on future claims, necessitating a proactive rather than reactive approach. Careful judgment is required to balance the need for accurate forecasting with the inherent uncertainties of future events, ensuring that underwriting decisions are both prudent and competitive. The correct approach involves utilizing a combination of historical data, current market intelligence, and expert judgment to identify emerging trends that could affect claims frequency or severity. This proactive stance aligns with the regulatory expectation for insurers to manage their risks effectively and maintain adequate reserves. Specifically, under the principles of sound financial management and prudent underwriting, regulators expect insurers to anticipate future liabilities. This approach demonstrates a commitment to long-term sustainability and adherence to the spirit of regulatory oversight, which aims to protect policyholders and the financial stability of the insurance market. An incorrect approach that relies solely on historical data without considering current or future influencing factors fails to account for the dynamic nature of risk. This can lead to underpricing of risk and inadequate reserving, potentially exposing the insurer to financial distress. Such a failure would contravene regulatory requirements for accurate risk assessment and financial prudence. Another incorrect approach that focuses exclusively on short-term market fluctuations without a broader understanding of underlying economic or societal shifts overlooks significant drivers of long-term risk. This can result in underwriting decisions that are either overly conservative, leading to a loss of market share, or insufficiently cautious, leading to unexpected losses. This demonstrates a lack of comprehensive risk management, which is a cornerstone of regulatory compliance. A further incorrect approach that dismisses expert opinions or qualitative insights in favor of purely quantitative, albeit potentially outdated, data ignores valuable information that can illuminate emerging risks. This can lead to a blind spot in the underwriting process, failing to capture qualitative shifts that may have significant quantitative implications. This approach neglects the holistic nature of risk assessment expected by regulators. The professional decision-making process for similar situations should involve a structured approach to trend analysis. This includes 1. Establishing clear objectives for the analysis. 2. Gathering relevant data from diverse sources, historical, market, economic, social. 3. Applying appropriate analytical techniques, qualitative and quantitative. 4. Critically evaluating the findings, considering potential biases and limitations. 5. Developing actionable insights and recommendations. And 6. Regularly reviewing and updating the analysis as new information becomes available. This iterative process ensures that underwriting decisions are informed by the most current and relevant understanding of risk. Question 7. Benchmark analysis indicates that a commercial bank is considering participating in a large syndicated loan facility for a corporate borrower. The lead arranger, a reputable global bank, has provided a preliminary information memorandum and a proposed loan agreement. The participant underwriter's primary responsibility is to assess the risk of this participation for their institution. Which of the following approaches best aligns with regulatory expectations for prudent risk assessment in loan syndication? Option A. Accept the loan documentation as presented by the lead arranger, assuming it reflects standard market practice and adequately protects all parties. Option B. Conduct a comprehensive review of the lead arranger's credit assessment, loan documentation, and proposed terms, and supplement this with the participant's own independent analysis of the borrower's creditworthiness and the relevant industry sector. Option C. Focus predominantly on the proposed participation fee and the potential yield, ensuring it adequately compensates for the perceived risk without extensive scrutiny of the underlying credit. Option D. Rely primarily on the lead arranger's established reputation and their stated credit rating for the borrower, assuming their due diligence is sufficient. The correct answer is B. Conduct a comprehensive review of the lead arranger's credit assessment, loan documentation, and proposed terms, and supplement this with the participant's own independent analysis of the borrower's creditworthiness and the relevant industry sector. Explanation. This scenario is professionally challenging because it requires an underwriter to assess the risk of a loan syndication participation without direct control over the lead arranger's due diligence or loan documentation. The underwriter must rely on the lead arranger's expertise and reporting, while still fulfilling their own fiduciary duty to their institution. The core challenge lies in balancing the efficiency of participating in a syndicated loan with the imperative of independent risk assessment and compliance with regulatory expectations for sound lending practices. The correct approach involves a thorough review of the lead arranger's credit assessment, loan documentation, and proposed terms, supplemented by the participant's own independent analysis of the borrower's creditworthiness and the industry sector. This approach is right because it aligns with regulatory expectations for prudent risk management in loan syndications. Specifically, it addresses the Financial Conduct Authority (FCA) principles, such as Principle 3, customers, treat customers fairly, and Principle 2, skill, care, and diligence, by ensuring that the participant underwriter exercises due care and diligence in assessing the risks associated with the loan participation. It also implicitly supports Principle 6, communicating with clients, by ensuring that the participant has a clear understanding of the risks being assumed, which would be crucial if they were to communicate these to their own stakeholders. The participant's independent analysis ensures they are not solely relying on the lead arranger's potentially biased or incomplete assessment, thereby mitigating the risk of poor credit decisions and potential regulatory censure for inadequate due diligence. An incorrect approach that relies solely on the lead arranger's reputation and stated credit rating fails because it abdicates the participant's responsibility for independent risk assessment. This is a regulatory failure as it contravenes the expectation of due diligence and can lead to a breach of Principle 2, skill, care, and diligence, by not exercising sufficient care in evaluating the investment. It also poses an ethical failure by potentially exposing the participant's institution to undue risk without proper scrutiny. Another incorrect approach that focuses only on the fee structure and potential return without scrutinizing the underlying credit risk is also professionally unacceptable. This demonstrates a disregard for sound lending principles and regulatory expectations. It prioritizes short-term financial gain over long-term risk management, which is a direct violation of the spirit and letter of regulatory guidance on prudent lending and risk appetite. Such an approach could lead to significant financial losses and reputational damage, and would likely be viewed by regulators as a failure to uphold Principle 3, customers, treat customers fairly, if it leads to losses for the participant's institution or its clients, and Principle 2, skill, care, and diligence, by not applying appropriate skill and care. The professional decision-making process for similar situations should involve establishing clear internal policies and procedures for loan syndication participation. This includes defining minimum due diligence requirements, setting risk appetite limits, and outlining the roles and responsibilities of both the lead arranger and the participant. Underwriters should be trained to critically evaluate information provided by lead arrangers, to perform independent credit analysis, and to escalate concerns to senior management when necessary. The decision to participate should be based on a comprehensive understanding of the risks and rewards, aligned with the institution's overall risk management framework and regulatory obligations. Question 8. The audit findings indicate that the underwriting team for a large manufacturing client has consistently relied on historical claims data and the client's established market reputation when assessing renewal terms, with minimal specific inquiry into the client's supply chain resilience and key supplier dependencies. Which approach best aligns with regulatory expectations for commercial underwriting principles in this jurisdiction? Option A. Continue to rely on historical claims data and the client's market reputation, as these are established indicators of risk for long-standing clients. Option B. Conduct a detailed review of the client's supplier contracts and operational documentation to identify critical dependencies and potential single points of failure, using this analysis to inform pricing and coverage. Option C. Discount the significance of supplier dependence as a risk factor, assuming that large, established companies have diversified supply chains and are inherently resilient. Option D. Prioritize rapid renewal processing by making standard assumptions about supplier stability for large, reputable clients. The correct answer is B. Conduct a detailed review of the client's supplier contracts and operational documentation to identify critical dependencies and potential single points of failure, using this analysis to inform pricing and coverage. Explanation: this scenario is professionally challenging because it requires underwriters to balance the need for efficient operations with robust risk management, specifically concerning supplier dependence and potential disruptions. The challenge lies in identifying and quantifying the impact of these risks within the constraints of regulatory requirements, which mandate a thorough understanding of the insured's business and its vulnerabilities. Careful judgment is required to ensure that the underwriting decision accurately reflects the risk profile without imposing undue burdens or overlooking critical exposures. The correct approach involves a detailed review of the insured supplier contracts and operational dependencies to identify single points of failure or critical reliance on a limited number of suppliers. This aligns with regulatory expectations that underwriters must possess sufficient knowledge of the insured's business to underwrite effectively. Specifically, within the UK regulatory framework, the Financial Conduct Authority (FCA) Handbook, particularly principles related to customers' interests (PRIN 2) and adequate financial resources (FIT 4), implicitly requires firms to understand the risks that could impact their ability to serve customers or maintain financial stability. For commercial underwriting, this translates to assessing risks that could lead to claims or business failure. A thorough assessment of supplier dependence directly addresses the potential for operational disruptions that could lead to business interruption claims or an inability to meet contractual obligations, thereby impacting the insured's viability and potentially leading to claims against the insurer. An incorrect approach that focuses solely on the historical claims experience of the insured, without considering underlying operational risks like supplier dependence, fails to meet regulatory expectations for a forward-looking risk assessment. This overlooks potential future disruptions that have not yet manifested in claims, but pose a significant threat. Such an approach could be seen as a breach of PRIN 2, as it does not adequately consider the full spectrum of risks that could affect the insured's ability to operate and meet its obligations, potentially leading to financial distress and subsequent claims. Another incorrect approach that prioritizes speed of quotation over in-depth risk analysis by making assumptions about supplier stability also falls short. This disregards the principle of due diligence inherent in underwriting and could violate the spirit of FIT 4 by not ensuring adequate consideration of the risks being underwritten. The FCA expects firms to have robust processes for assessing risk, and a superficial review that relies on assumptions rather than evidence is insufficient. Third incorrect approach that dismisses supplier dependence as a material risk, because the insured is a large, established company, fails to recognize that even large entities can be vulnerable to supply chain disruptions. This demonstrates a lack of understanding of modern supply chain complexities and can lead to underpricing of risk and inadequate coverage, potentially contravening the duty to act honestly, with integrity and skill, and with due care and diligence. PRIN 2.1.1. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with understanding the insured's business operations, identifying key dependencies, including suppliers, evaluating the potential impact of disruptions, and then determining appropriate underwriting actions, such as pricing adjustments, coverage limitations, or requiring risk mitigation strategies from the insured. This systematic approach ensures that all material risks are considered in line with regulatory expectations. Question 9. Research into the financial health of a commercial applicant reveals that their latest income statement shows a significant increase in net profit compared to the previous year, and their balance sheet indicates a healthy level of total assets. Which approach to financial statement analysis best demonstrates a commitment to thorough underwriting principles. Option A, prioritizing the analysis of the most recent year's financial performance to gauge the applicant's current market position. Option B, reviewing only the cash flow from investing activities to understand how the applicant is managing its long-term investments. Option C, examining the trend of revenue growth, the quality of earnings by analyzing the relationship between net profit and cash flow from operations, and assessing the composition and liquidity of assets and liabilities on the balance sheet. Option D, focusing primarily on the reported net profit figure and the total asset value to determine the applicant's overall financial strength. The correct answer is C, examining the trend of revenue growth, the quality of earnings by analyzing the relationship between net profit and cash flow from operations, and assessing the composition and liquidity of assets and liabilities on the balance sheet. Explanation: this scenario is professionally challenging because it requires an underwriter to move beyond superficial financial data and critically assess the underlying quality and sustainability of a company's financial performance. The challenge lies in discerning genuine financial health from potentially misleading presentations, which necessitates a deep understanding of accounting principles and their application in risk assessment. Careful judgment is required to identify red flags and to ensure that underwriting decisions are based on a robust and accurate understanding of the applicant's financial position. The correct approach involves a comprehensive review of the balance sheet, income statement, and cash flow statement, with a particular emphasis on analyzing trends, ratios, and the quality of earnings and assets. This includes scrutinizing significant changes in account balances, assessing the relationship between profit and cash flow, and evaluating the company's ability to meet its short-term and long-term obligations. This approach aligns with the principles of prudent underwriting, which mandates a thorough due diligence process to protect the insurer from adverse selection and to ensure fair pricing of risk. Regulatory frameworks, such as those governing financial services and insurance, typically require underwriters to act with due skill, care, and diligence, and to make decisions based on sound financial analysis. Ethical considerations also demand transparency and fairness, meaning that decisions should not be based on incomplete or misrepresented financial information. An incorrect approach that focuses solely on headline figures like total revenue or net profit without examining the underlying components fails to meet the standard of due diligence. This can lead to an underestimation of risk, as positive headline figures might mask deteriorating operational efficiency, unsustainable revenue streams, or significant off-balance sheet liabilities. Such a failure could contravene regulatory requirements for adequate risk assessment and potentially expose the insurer to financial losses. Another incorrect approach that prioritizes recent performance over historical trends overlooks the importance of stability and sustainability. A single period of strong performance may be an anomaly, and a more comprehensive view of financial history is necessary to identify cyclicality, seasonality, or the impact of one-off events. Relying on a short-term snapshot can lead to an inaccurate assessment of the company's long-term viability and its capacity to withstand economic downturns, thereby violating the principle of thorough risk evaluation. A further incorrect approach that neglects the analysis of cash flow from operations in favor of other cash flow activities, such as financing or investing, is also problematic. While these other activities are important, the ability of a business to generate cash from its core operations is a fundamental indicator of its health and sustainability. A company that consistently shows profits but struggles to generate positive cash flow from operations may be employing aggressive accounting practices or facing underlying operational issues, which could pose a significant risk. This oversight can lead to an underestimation of liquidity risk and solvency concerns, contrary to the regulatory expectation of a holistic financial assessment. The professional decision-making process for similar situations should involve a structured and systematic review of all available financial statements. Underwriters should develop a checklist of key areas to examine within each statement, focusing on trends, anomalies, and the interrelationships between different financial metrics. They should be prepared to ask probing questions of the applicant and to seek clarification on any areas of concern. Furthermore, staying abreast of evolving accounting standards and industry-specific financial reporting practices is crucial for maintaining a high level of analytical competence. Question 10. To address the challenge of ensuring adequate security for a commercial loan, an underwriter is reviewing the proposed collateral. The borrower has provided a recent appraisal for a piece of specialized industrial equipment. The underwriter needs to determine the most appropriate process for evaluating this collateral, considering its valuation, liquidity, and the lender's control. Option A. Focus solely on the loan-to-value ratio based on the provided appraisal, without investigating the equipment's marketability or the specifics of the lender's control over it. Option B. Rely on the borrower's assurance that the equipment is in good working order and assume that its value will remain stable over the loan term. Option C. Accept the borrower's provided appraisal at face value and proceed with the loan approval, assuming the equipment is readily marketable. Option D. Engage an independent, accredited appraiser to conduct a new valuation of the equipment and research the typical market for such specialized machinery to assess its liquidity and confirm the lender's ability to enforce security interests. Correct answer is C. Accept the borrower's provided appraisal at face value and proceed with the loan approval, assuming the equipment is readily marketable. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for robust collateral to mitigate risk with the practicalities of business operations and the specific regulatory requirements for valuation, liquidity, and control. Overly stringent collateral requirements can stifle business growth and lead to lost opportunities, while insufficient collateral exposes the lender to unacceptable levels of risk. The underwriter must exercise sound judgment, informed by the specific regulatory framework governing commercial underwriting, to ensure that collateral is adequate, properly valued, readily convertible to cash if needed, and under the lender's effective control. The correct approach involves a systematic and documented assessment of collateral against established underwriting standards and regulatory guidelines. This includes verifying the valuation of the collateral through independent and reputable sources, assessing its liquidity by considering marketability and potential for rapid sale, and ensuring the lender has clear legal control over the collateral, preventing its disposal by the borrower without consent. This aligns with the regulatory imperative to maintain prudent lending practices, protect the lender's assets, and ensure the financial stability of the institution. Adherence to these principles is crucial for demonstrating due diligence and compliance with the commercial underwriting principles exam's jurisdictional framework. An incorrect approach would be to rely solely on the borrower's self-reported valuation without independent verification. This fails to meet the regulatory requirement for objective valuation and exposes the lender to the risk of overstating the collateral's worth, thereby increasing potential losses. Another incorrect approach is to accept collateral that is illiquid or difficult to sell, such as highly specialized machinery with a limited market. This contravenes the principle of ensuring collateral can be readily converted to cash to cover outstanding debt, a key aspect of risk mitigation mandated by regulatory bodies. Furthermore, accepting collateral where the lender's control is ambiguous or easily circumvented, such as allowing the borrower to retain possession and use of the collateral without clear security agreements or restrictions, is a significant regulatory and ethical failure. This lack of control undermines the very purpose of collateral as security for the loan. Professionals should approach collateral analysis by first understanding the specific nature of the collateral and its relevance to the borrower's business. They must then consult and strictly adhere to the valuation, liquidity, and control guidelines stipulated by the commercial underwriting principles exam's jurisdiction. This involves a multifaceted assessment, often requiring input from internal specialists or external valuers, and a thorough review of legal documentation to confirm the lender's rights. The decision-making process should be documented, demonstrating a clear rationale based on risk assessment and regulatory compliance. Question 11. Analysis of a commercial underwriter's process for a mortgage application reveals a potential gap in adhering to consumer protection laws. The underwriter, aiming for a swift closing, has a practice of providing the loan estimate only after initial underwriting approval and includes a standard adverse action notice with a placeholder for credit score information, to be filled in only if the loan is denied. What is the most compliant approach to ensure adherence to the Truth in Lending Act and the Fair Credit Reporting Act? Option A. Provide the loan estimate within 3 business days of application receipt and include a fully completed adverse action notice with the credit score and credit reporting agency contact information if adverse action is taken. Option B. Provide the loan estimate after initial underwriting approval and include a generic adverse action notice with a placeholder for credit score information. Option C. Delay providing the loan estimate until the loan is fully approved to streamline internal processes. Option D. Assume the applicant has received all necessary disclosures and only provide them upon specific request. The correct answer is A. Provide the loan estimate within 3 business days of application receipt and include a fully completed adverse action notice with the credit score and credit reporting agency contact information if adverse action is taken. Explanation. This scenario presents a professional challenge because it requires an underwriter to balance the need for efficient loan processing with the stringent disclosure requirements mandated by consumer protection laws. The challenge lies in ensuring that all necessary information is provided to the consumer in a timely and understandable manner, without creating undue delays or overwhelming the applicant. Careful judgment is required to interpret the spirit and letter of the law, particularly when dealing with complex loan products or diverse applicant needs. The correct approach involves proactively identifying all required disclosures under the Truth in Lending Act (TILA) and the Fair Credit Reporting Act (FCRA) at the earliest stages of the application process. This includes providing the loan estimate within 3 business days of receiving the application and ensuring that any adverse action based on credit information is accompanied by a proper adverse action notice that includes the credit score and the credit reporting agency's contact information. This approach is correct because it directly adheres to the regulatory timelines and content requirements of TILA and FCRA, thereby protecting the consumer's right to informed decision-making and fair credit practices. It demonstrates a commitment to compliance and ethical underwriting. An incorrect approach would be to delay providing the loan estimate until the loan is nearly approved, citing internal processing efficiency. This fails to meet the TILA requirement of providing the loan estimate within 3 business days of application, thereby hindering the consumer's ability to shop for the best loan terms and potentially violating their right to timely disclosure. Another incorrect approach would be to provide a generic adverse action notice without including the specific credit score and the contact information for the credit reporting agency. This violates the FCRA requirement for specific information in adverse action notices, preventing the consumer from understanding the basis of the decision and from taking steps to correct any inaccuracies in their credit report. A further incorrect approach would be to assume the applicant has received all necessary disclosures without verifying their receipt or understanding. This abdicates the underwriter's responsibility to ensure compliance and leaves the consumer vulnerable to making decisions without complete information, which is a direct contravention of the consumer protection principles embedded in TILA and FCRA. The professional reasoning process for similar situations should involve a thorough understanding of applicable consumer protection laws, a proactive approach to disclosure, and a commitment to clear and accurate communication with the applicant. Underwriters should establish internal checklists and workflows that ensure all regulatory requirements are met at each stage of the loan process. When in doubt, seeking clarification from compliance departments or legal counsel is essential to avoid regulatory violations and uphold ethical standards. Question 12. The investigation demonstrates that a commercial insurer is seeking to optimize its underwriting process for healthcare facilities, including hospitals, clinics, and nursing homes. The goal is to improve efficiency without compromising the accuracy of risk assessment. Which of the following approaches best aligns with the principles of process optimization in healthcare underwriting, adhering strictly to the regulatory framework governing commercial insurance? Option A. Relying on the personal experience and reputation of the facility's management team to gauge the overall risk profile, with minimal reliance on detailed operational data. Option B. Implementing a standardized checklist that quantifies key operational metrics and compliance indicators, allowing for automated flagging of high-risk facilities for further in-depth review. Option C. Focusing exclusively on the historical claims data of a facility, assuming that past performance is the sole determinant of future risk. Option D. Expediting the underwriting process by accepting facility-provided summaries of operational performance without independent verification of critical data points. The correct answer is B. Implementing a standardized checklist that quantifies key operational metrics and compliance indicators, allowing for automated flagging of high-risk facilities for further in-depth review. Explanation. The investigation demonstrates a common challenge in healthcare underwriting, balancing the need for efficient process optimization with the imperative to maintain rigorous risk assessment and regulatory compliance. Underwriters must navigate complex operational data from healthcare facilities to identify potential risks without introducing bias or overlooking critical indicators. The professional challenge lies in developing systematic approaches that are both effective in streamlining the underwriting process and robust enough to ensure fair and accurate risk evaluation, adhering strictly to the principles of commercial underwriting as defined by the relevant regulatory framework. The correct approach involves a data-driven, systematic review that prioritizes objective risk indicators and operational efficiency. This method aligns with the principles of sound underwriting by focusing on quantifiable data and established risk assessment protocols. It ensures that the underwriting decision is based on a comprehensive understanding of the facility's operational health and potential liabilities, thereby fulfilling the underwriter's duty to assess risk accurately and ethically, in line with regulatory expectations for due diligence. An approach that relies heavily on anecdotal evidence or subjective assessments is professionally unacceptable because it deviates from objective risk evaluation. This can lead to biased underwriting decisions, potentially resulting in unfair pricing or denial of coverage based on non-quantifiable factors. Such a method fails to meet the regulatory requirement for evidence-based decision-making and undermines the integrity of the underwriting process. Another incorrect approach involves prioritizing speed of processing over the thoroughness of the risk assessment. While efficiency is desirable, it should not come at the expense of identifying significant risks. This can lead to overlooking critical operational deficiencies or compliance issues that could result in future claims, thereby exposing the insurer to unacceptable levels of risk and failing to uphold the principle of prudent underwriting. A further flawed approach might involve focusing solely on financial statements without adequately considering operational aspects. While financial health is important, it does not always reflect the day-to-day operational risks inherent in healthcare facilities, such as patient care quality, staffing levels, or regulatory compliance. A comprehensive underwriting process requires a holistic view that integrates financial, operational, and clinical risk factors. Professionals should adopt a decision-making framework that begins with clearly defined underwriting guidelines and risk appetite. This framework should then incorporate a systematic data collection and analysis process, utilizing objective metrics and established risk assessment tools. Regular review and validation of these processes against regulatory requirements and industry best practices are crucial for maintaining a high standard of professional judgment and ensuring consistent, fair, and compliant underwriting outcomes. Question 13. During the evaluation of a commercial loan application, an underwriter identifies that the applicant's debt-to-equity ratio slightly exceeds the maximum threshold stipulated in the firm's credit policy. The applicant is a key prospective client, and the sales team is eager to secure the business. The underwriter is aware that the applicant has a strong historical repayment record and a solid business plan for future growth. What is the most appropriate course of action for the underwriter to take in accordance with regulatory principles and sound underwriting practices? Option A. Reject the application immediately due to the applicant's debt-to-equity ratio exceeding the policy limit, without further consideration. Option B. Seek approval from a senior underwriter or credit committee, providing a detailed rationale for the deviation, including supporting documentation on the applicant's repayment history and growth prospects before making a final decision. Option C. Approve the application with a note in the file indicating the applicant's strong repayment history and future growth potential as justification for the minor deviation from the credit policy. Option D. Approve the application and inform the applicant that they will need to rectify their debt-to-equity ratio within the next 6 months to maintain the loan facility. Correct answer is C. Approve the application with a note in the file indicating the applicant's strong repayment history and future growth potential as justification for the minor deviation from the credit policy. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need to secure business with the imperative to adhere to the firm's established credit policy and regulatory requirements. The pressure to meet targets can lead to a temptation to overlook or downplay potential risks, which directly contravenes the underwriter's duty to assess risk accurately and within defined parameters. Careful judgment is required to ensure that any deviation from policy is justified, documented, and approved, rather than being a unilateral decision driven by commercial expediency. The correct approach involves a thorough review of the applicant's financial standing against the credit policy's established criteria, including an assessment of their credit history, financial ratios, and any available collateral. If the applicant falls outside the standard parameters, the underwriter must then follow the defined escalation procedure, which typically involves seeking approval from a senior underwriter or credit committee, providing a clear rationale for the proposed deviation, and documenting all discussions and decisions. This approach is correct because it upholds the principles of sound underwriting, ensures consistent application of risk appetite, and complies with regulatory expectations for robust risk management frameworks. Specifically, it aligns with the principles of responsible lending and the need for a clear, documented, and auditable decision-making process, as often mandated by financial regulators to prevent undue risk-taking and protect the firm's financial stability. An incorrect approach of approving the application without full adherence to the credit policy, despite identifying potential weaknesses, is professionally unacceptable. This failure constitutes a breach of the underwriter's fiduciary duty to the firm and its stakeholders, as it exposes the firm to increased credit risk without proper authorization or mitigation. It also undermines the integrity of the credit policy, creating a precedent for future noncompliance and potentially leading to a deterioration of the firm's overall risk profile. Such an action could also be viewed as a violation of regulatory requirements related to internal controls and risk management, potentially leading to sanctions. Another incorrect approach of rejecting the application solely based on a minor deviation from the credit policy, without considering the applicant's overall profile or exploring potential mitigating factors, is also professionally problematic. While adherence to policy is crucial, a rigid application without considering context can lead to lost business opportunities and may not always reflect a nuanced understanding of risk. However, in the context of this question, the primary focus is on the risk of overlooking policy requirements due to commercial pressure. A third incorrect approach of approving the application with a verbal assurance from the applicant that they will improve their financial standing in the future, without any formal agreement or mechanism for follow-up, is also unacceptable. This relies on an informal commitment that lacks enforceability and does not adequately address the current risk posed by the applicant's financial position. It bypasses the established procedures for risk mitigation and documentation, leaving the firm exposed. The professional decision-making process for similar situations should involve a systematic review of the application against the credit policy, a clear identification of any deviations, a thorough assessment of the implications of these deviations, and strict adherence to the firm's established procedures for handling exceptions, including seeking appropriate approvals and documenting all decisions and justification. This ensures that decisions are risk-based, compliant, and defensible. Question 14. The assessment process reveals that a proposed commercial loan facility is to be secured by assets that are also subject to a prior security interest held by another lender, with an intercreditor agreement governing the rights and priorities of both lenders. Which of the following approaches to underwriting this facility best aligns with sound commercial underwriting principles and regulatory expectations for risk management? Option A. Underwrite the facility by focusing exclusively on the borrower's ability to service the debt, as the intercreditor agreement primarily concerns the relationship between creditors and not the borrower's repayment capacity. Option B. Conduct a thorough review of the intercreditor agreement to understand its specific terms, assess the impact on the lender's priority of claims and security, and incorporate this analysis into the risk assessment and loan pricing. Option C. Rely on a standard template for underwriting loans with intercreditor agreements, assuming all such agreements have similar implications for risk. Option D. Proceed with underwriting based solely on the borrower's current financial health and projected cash flows, assuming the intercreditor agreement's impact on collateral priority is a secondary concern. The correct answer is D. Proceed with underwriting based solely on the borrower's current financial health and projected cash flows, assuming the intercreditor agreement's impact on collateral priority is a secondary concern. Explanation. This scenario is professionally challenging because intercreditor agreements, while common in commercial lending, introduce complexity by potentially altering the statutory or contractual rights of creditors. Underwriting these agreements requires a deep understanding of how they impact the priority of claims, security interests, and recourse available to different lenders. The challenge lies in accurately assessing the risk introduced by these subordination provisions and ensuring that the underwriting decision reflects the true economic position of the borrower and the lender's security. A failure to properly interpret or account for the terms of an intercreditor agreement can lead to mispriced risk, inadequate collateral coverage, and potential losses for the underwriting institution. The correct approach involves a thorough review of the intercreditor agreement to understand its specific terms and their implications for the underwriting. This includes identifying any waivers of rights, subordination of claims, or limitations on enforcement actions. The underwriter must then assess how these provisions affect the lender's priority of payment and the value of its security interest in the event of default. Regulatory frameworks, such as those governing prudential supervision of financial institutions, often require lenders to maintain adequate capital and risk management practices. Properly underwriting an intercreditor agreement ensures that the lender's risk profile is accurately reflected in its capital allocation and provisioning, thereby adhering to principles of sound financial management and regulatory compliance. This approach prioritizes a comprehensive understanding of contractual obligations and their impact on financial risk. An incorrect approach would be to disregard the intercreditor agreement, assuming it does not materially affect the borrower's creditworthiness or the lender's security. This failure to acknowledge the contractual subordination of claims or the alteration of enforcement rights directly contravenes the principle of accurate risk assessment. It can lead to a misrepresentation of the lender's actual exposure and a violation of internal risk management policies and potentially regulatory expectations for prudent lending. Another incorrect approach is to only consider the borrower's financial statements without analyzing the intercreditor agreement's impact on the lender's recourse. This overlooks the critical aspect of how the agreement dictates the order of repayment and the availability of collateral in a default scenario. It represents a failure to conduct due diligence on the entire credit structure, which is essential for sound underwriting and compliance with regulatory requirements that mandate a holistic view of credit risk. Finally, an incorrect approach is to assume that all intercreditor agreements are standard and can be underwritten based on general principles without specific review. This overlooks the fact that the terms of these agreements can vary significantly and have profound implications for lender rights. It demonstrates a lack of diligence and a failure to apply the specific knowledge required for complex credit structures, potentially leading to regulatory scrutiny for inadequate risk assessment and management. The professional decision-making process for similar situations should involve a structured approach. First, identify all relevant contractual agreements, including intercreditor agreements. Second, conduct a detailed review of these agreements, focusing on provisions that alter standard creditor rights. Third, assess the impact of these provisions on the borrower's creditworthiness and the lender's security and recourse. Fourth, quantify the resulting risk and ensure it is adequately reflected in the underwriting decision, pricing, and any required capital or provisioning. Finally, document the analysis and decision-making process thoroughly. Question 15. Compliance review shows that a potential client has verbally agreed to the terms of a proposed commercial insurance policy, and the underwriter has indicated their intention to issue the policy. However, a formal written contract has not yet been exchanged, and the specific details of the coverage, including the exact premium and deductible amounts, are still subject to final confirmation. Which of the following approaches best reflects the legally sound and professionally responsible course of action for the underwriter? Option A. Proceed with issuing the policy, but clearly state in the policy documents that the agreement is conditional upon the final confirmation of all terms and conditions, thereby creating a binding contract subject to these conditions. Option B. Consider the verbal agreement as a preliminary indication of interest and continue negotiations, seeking to formalize all terms and conditions in a written agreement before any commitment is made by either party. Option C. Issue the policy immediately, assuming the verbal agreement and subsequent confirmation will constitute a binding contract, as is common practice in some commercial dealings. Option D. Advise the client that a binding contract cannot be formed until all essential terms and conditions are clearly agreed upon, documented, and formally accepted by both parties in writing, and that the insurer cannot be legally bound until this process is complete. The correct answer is C. Issue the policy immediately, assuming the verbal agreement and subsequent confirmation will constitute a binding contract, as is common practice in some commercial dealings. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need to secure business with the fundamental legal requirements of contract formation. Misinterpreting or overlooking essential elements of contract law can lead to unenforceable agreements, financial loss, and regulatory breaches. The underwriter must exercise careful judgment to ensure that any commitment made is legally sound and aligns with the insurer's risk appetite and underwriting guidelines. The correct approach involves identifying and confirming the presence of all essential elements of a valid contract: offer, acceptance, consideration, intention to create legal relations, and capacity. Specifically, the underwriter must ensure that the proposed terms constitute a clear offer, that there is unequivocal acceptance of that offer, and that both parties are providing something of value, consideration. Furthermore, the intention to be legally bound must be evident, and both parties must have the legal capacity to enter into the contract. This approach is correct because it directly adheres to the foundational principles of contract law, which are implicitly or explicitly mandated by regulatory frameworks governing insurance. Adherence to these principles ensures that the insurer is entering into legally binding and enforceable agreements, thereby protecting its assets and fulfilling its obligations to policyholders. This aligns with the regulatory expectation that insurers operate with due diligence and sound risk management practices, which includes ensuring the legal validity of their contracts. An incorrect approach would be to proceed with the assumption that a verbal agreement or a preliminary discussion constitutes a binding contract without verifying the presence of all legal elements. This is a regulatory failure because it risks entering into agreements that are not legally enforceable, potentially exposing the insurer to claims that cannot be defended in court. It also demonstrates a lack of due diligence in underwriting, which regulators expect to be thorough. Another incorrect approach is to focus solely on the commercial expediency of securing the business, overlooking the need for clear and unambiguous terms. This is ethically problematic as it could lead to disputes and misunderstandings with the client, and it fails to uphold the insurer's responsibility to provide clear and legally sound insurance products. A further incorrect approach is to rely on industry custom or past practices without confirming their legal validity in the current context. While custom can inform interpretation, it cannot substitute for the essential legal requirements of contract formation. This is a regulatory failure as it suggests a disregard for the specific legal framework governing contracts. The professional decision-making process for similar situations should involve a structured assessment of contract formation. First, the underwriter should identify the proposed terms and determine if they constitute a clear offer. Second, they must ascertain if there has been a clear and unequivocal acceptance of that offer. Third, they should verify that valid consideration exists for both parties. Fourth, they must assess whether there is a clear intention to create legal relations. Finally, they must confirm that all parties have the legal capacity to contract. If any of these elements are unclear or absent, the underwriter should seek clarification or legal advice before committing the insurer, rather than proceeding on assumptions. Question 16. Comparative studies suggest that the effectiveness of real estate loan documentation in mitigating lender risk is heavily influenced by the diligence applied during the review process. In the context of UK commercial property lending, which of the following approaches to verifying the legal charge over the borrower's property best aligns with regulatory expectations and professional best practice? Option A. Accepting the loan documentation based on the borrower's assurance that the legal charge is in order and has been prepared by their solicitors. Option B. Relying on the borrower's solicitor to confirm the charge's validity without independent verification of its registration status. Option C. Proceeding with the loan approval once a preliminary draft of the legal charge has been provided, with a commitment to ensure final registration post-completion. Option D. Verifying that the legal charge has been duly executed by the borrower and is correctly registered with both Companies House and the Land Registry, ensuring it accurately reflects the loan terms and contains no unduly restrictive covenants. The correct answer is D. Verifying that the legal charge has been duly executed by the borrower and is correctly registered with both Companies House and the Land Registry, ensuring it accurately reflects the loan terms and contains no unduly restrictive covenants. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the underwriter to balance the lender's need for security with the borrower's ability to meet obligations, all within the strict confines of UK regulatory requirements for commercial real estate lending. The underwriter must critically assess the adequacy and enforceability of loan documentation, particularly the legal charge over the property, to ensure it provides sufficient recourse for the lender in case of default. Failure to do so could expose the lender to significant financial loss and potential regulatory sanctions for inadequate risk management. Correct approach analysis. The correct approach involves a thorough review of the legal charge to confirm it accurately reflects the loan terms, is properly registered with Companies House and the Land Registry, and contains no onerous covenants or restrictions that could impede enforcement. This ensures compliance with the principles of secured lending and the legal requirements for creating and perfecting a charge over commercial property in the UK. Specifically, it aligns with the Financial Conduct Authority's (FCA) principles for business, which mandate that firms must conduct their business with integrity, due skill, care, and diligence, and have adequate systems and controls in place to manage risks. The legal charge is the cornerstone of the lender's security, and its validity and enforceability are paramount. Incorrect approaches analysis. Accepting the loan documentation without verifying the legal charge's registration status is an ethical and regulatory failure. It bypasses a critical step in perfecting the lender's security, potentially rendering the charge voidable or unenforceable against third parties, which is a breach of the duty of care owed to the lender. Relying solely on the borrower's assurance that the charge is in order, without independent verification, is a significant lapse in due diligence and risk management, exposing the lender to undue risk and contravening the FCA's requirement for robust internal controls. Approving the loan based on a preliminary draft of the legal charge, without confirmation of its final execution and registration, is premature and introduces uncertainty regarding the lender's security position. This demonstrates a lack of diligence and an inadequate understanding of the legal process required to secure commercial property loans, potentially leading to a situation where the lender's security is not legally established. Professional reasoning. Professionals should adopt a systematic approach to reviewing loan documentation. This involves 1. Understanding the specific regulatory framework governing the transaction, in this case, UK Financial Services Regulations. 2. Identifying all critical documentation required to secure the lender's interest, with a particular focus on the legal charge for real estate. 3. Establishing a clear checklist of verification steps for each document, including independent confirmation of registration and legal validity. 4. Escalating any discrepancies or uncertainties to legal counsel for expert advice before proceeding. This structured process ensures all regulatory obligations are met and the lender's interests are adequately protected. Question 17. The audit findings indicate a potential underestimation of risk due to a lack of integrated assessment of manufacturing operations, specifically concerning the interplay between critical equipment uptime, raw material, and finished goods inventory levels, and the reliability of the supply chain. Which of the following approaches best addresses these findings in accordance with sound commercial underwriting principles? Option A. Implement a standardized increase in the premium for all manufacturing policies that exhibit high levels of inventory or reliance on complex machinery, without further investigation into specific operational details. Option B. Focus solely on the financial impact of potential equipment breakdowns on the insured's business interruption exposure, disregarding the broader implications for inventory and supply chain continuity. Option C. Conduct a detailed review of the insured supply chain contracts and inventory management systems, alongside an assessment of the maintenance and operational history of critical manufacturing equipment, to understand how failures in one area could impact the others. Option D. Request updated declarations from the insured regarding their equipment maintenance schedules and inventory valuation methods, assuming this information is sufficient for risk assessment. The correct answer is C. Conduct a detailed review of the insured supply chain contracts and inventory management systems, alongside an assessment of the maintenance and operational history of critical manufacturing equipment, to understand how failures in one area could impact the others. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need for comprehensive risk assessment with the practicalities of underwriting complex manufacturing operations. The auditor's findings highlight potential gaps in the underwriting process, specifically concerning the interconnectedness of equipment, inventory, and supply chain risks. A failure to adequately assess these interdependencies could lead to underpricing of risk, inadequate coverage, or the imposition of insufficient controls, ultimately impacting the insurer's profitability and solvency. Careful judgment is required to determine the most effective and compliant approach to address these findings. The correct approach involves a holistic review of the manufacturing process, focusing on the interdependencies between equipment, inventory, and supply chain. This means not just assessing each element in isolation, but understanding how a failure in one area can cascade and impact others. For example, a breakdown in critical manufacturing equipment could lead to a significant buildup of raw material inventory or finished goods, increasing storage risks and potentially disrupting the supply chain for customers. Similarly, a disruption in a key supplier's operations could halt production, leading to inventory obsolescence or spoilage. This comprehensive approach aligns with the principles of sound underwriting, which mandate a thorough understanding of the risks being insured to ensure appropriate pricing and terms. Regulatory frameworks, such as those governing prudential regulation of insurers, emphasize the importance of robust risk management and underwriting practices to maintain financial stability. An incorrect approach would be to address each audit finding in isolation without considering their interconnectedness. For instance, focusing solely on the maintenance schedule of manufacturing equipment without evaluating how its failure might impact inventory levels or supply chain continuity would be a superficial response. This fails to address the root cause of the systemic risk identified by the audit. Ethically, this approach is deficient as it does not demonstrate due diligence in understanding the full scope of the risk being underwritten. Another incorrect approach would be to implement a blanket increase in premiums across all manufacturing policies without a detailed analysis of the specific risks identified in the audit. This is a reactive and potentially unfair response that does not reflect the nuanced nature of underwriting. It fails to differentiate between risks and could lead to overcharging for some insureds while still inadequately covering others. This approach also risks violating principles of fair pricing and could be seen as a failure to apply underwriting expertise. A further incorrect approach would be to rely solely on the insured's self-reported data regarding their equipment, inventory, and supply chain management without independent verification or further inquiry. While self-reported data is a starting point, a thorough underwriting process requires due diligence, which may include requesting additional documentation, conducting site visits, or seeking expert opinions. Over-reliance on unverified information can lead to significant underwriting errors and is contrary to the duty of care owed by the underwriter. The professional decision-making process for similar situations should involve a structured approach. 1. Acknowledge and understand the audit findings thoroughly. 2. Analyze the interdependencies between the identified risk areas, equipment, inventory, supply chain. 3. Develop a targeted underwriting strategy that addresses these interdependencies, potentially involving enhanced data collection, risk mitigation recommendations, or adjustments to terms and conditions. 4. Document the rationale for the underwriting decisions made. 5. Communicate findings and proposed actions clearly to relevant stakeholders, including the insured and internal management. 6. Continuously monitor the effectiveness of the implemented underwriting strategy. Question 18. Investigation of a new commercial trucking logistics client reveals they utilize a hybrid model, employing a fleet of their own vehicles alongside a significant number of independent contractors and third-party logistics providers, 3PL, for overflow and specialized transport. The client has provided a summary of their current insurance coverage, stating they have comprehensive general liability and auto liability policies in place. The underwriter needs to determine the most appropriate course of action to accurately assess the risk and ensure compliance with regulatory underwriting principles. Which of the following approaches best reflects sound professional judgment and regulatory adherence? Option A. Rely on the client's established positive business reputation within the industry to underwrite the risk, as this typically indicates responsible operational and insurance practices. Option B. Proceed with underwriting based on the client's self-reported coverage, without further investigation into the specifics of their contractual relationships or the insurance held by their contracted carriers. Option C. Request detailed contracts between the client and their independent contractors and 3PLs, along with proof of insurance for each contracted entity, to verify coverage responsibilities and identify any potential gaps. Option D. Accept the client's provided summary of their general liability and auto liability coverage as sufficient, assuming standard policies adequately address the risks associated with contracted carriers. The correct answer is C. Request detailed contracts between the client and their independent contractors and 3PLs, along with proof of insurance for each contracted entity, to verify coverage responsibilities and identify any potential gaps. Explanation. This scenario presents a professional challenge for a commercial underwriter due to the inherent risks and regulatory complexities within transportation underwriting, specifically concerning logistics operations. The underwriter must balance the need to accurately assess risk for a new client with the imperative to adhere strictly to the regulatory framework governing insurance in the specified jurisdiction. The client's operational model, involving a mix of owned and contracted carriers, introduces layers of complexity in determining liability and ensuring adequate coverage. The underwriter's judgment is critical in identifying potential gaps in coverage or misrepresentations that could lead to significant financial and legal repercussions for both the insurer and the insured. The correct approach involves a thorough due diligence process that prioritizes obtaining comprehensive and verifiable information directly from the client and their contracted carriers. This includes scrutinizing the client's contractual agreements with their third-party logistics providers, 3PL, and independent contractors to understand the flow of risk and insurance responsibilities. The underwriter must ensure that all parties involved have appropriate levels of coverage that align with the client's exposure, as mandated by relevant insurance regulations. This proactive verification process is essential for accurate risk assessment and compliance with underwriting principles that emphasize transparency and full disclosure. Adherence to these principles ensures that the policy issued accurately reflects the risk being insured and meets all statutory requirements, thereby protecting the insurer from adverse selection and the insured from underinsurance. An incorrect approach that relies solely on the client's self-reported information without independent verification is professionally unacceptable. This failure to conduct due diligence breaches the fundamental underwriting principle of risk assessment based on factual evidence. It exposes the insurer to significant risk if the client's reported coverage or operational practices are inaccurate, potentially leading to claims being denied, or the insurer bearing liability for risks not adequately priced or understood. This also violates regulatory expectations for prudent underwriting practices, which demand a robust investigation into the risk being insured. Another incorrect approach, which is to assume that standard logistics insurance policies automatically cover all aspects of a mixed carrier model without specific inquiry, is also professionally flawed. This demonstrates a lack of understanding of the nuances of transportation risk and the potential for coverage gaps. Regulations often require that policies be tailored to the specific risks presented, and a one-size-fits-all assumption can lead to non-compliance and inadequate protection. It fails to address the specific contractual relationships and insurance arrangements between the client and their contracted carriers, which are critical for determining ultimate liability. A third incorrect approach, which is to proceed with underwriting based on the client's reputation alone, without examining the specifics of their operational and insurance arrangements, is a significant ethical and regulatory failure. While reputation is a factor, it cannot substitute for a detailed risk assessment. This approach neglects the insurer's responsibility to understand the actual risks and the contractual mechanisms in place to manage them, can lead to the issuance of policies that do not adequately cover the exposures, potentially resulting in financial losses for the insurer and legal challenges related to misrepresentation or non-disclosure. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the scope of the risk and the client's operational model. Second, identify all relevant regulatory requirements and industry best practices. Third, develop a comprehensive information gathering plan, including requests for documentation from the client and their contracted carriers. Fourth, critically analyze the collected information to assess the accuracy of representations and identify potential risk exposures and coverage gaps. Finally, make an informed underwriting decision based on the verified information and in strict adherence to regulatory guidelines and ethical principles. Question 19. Strategic planning requires an underwriter to evaluate the introduction of a new, potentially high-margin commercial insurance product. Which of the following approaches best demonstrates a commitment to sound portfolio management and regulatory compliance? Option A. Focus exclusively on the underwriting guidelines for the new product in isolation, assuming that individual policy risks will not aggregate into a significant portfolio-level concern. Option B. Prioritize the immediate integration of the new product to capture market share and achieve short-term revenue targets, deferring a comprehensive risk assessment until the product line is established. Option C. Conduct a thorough analysis of the new product's potential profitability and market demand, while simultaneously assessing its impact on the existing portfolio's risk concentration, capital requirements, and overall diversification through stress testing. Option D. Rely on historical performance data of similar, but not identical, product lines to estimate the new product's risk profile, without a specific analysis of its unique characteristics or its impact on the current portfolio's aggregate exposure. The correct answer is C. Conduct a thorough analysis of the new product's potential profitability and market demand, while simultaneously assessing its impact on the existing portfolio's risk concentration, capital requirements, and overall diversification through stress testing. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the immediate profitability of a new, potentially lucrative business line against the long-term health and risk profile of the entire commercial insurance portfolio. A failure to adequately assess and manage the aggregate risk introduced by this new business could lead to significant financial strain on the insurer, potentially impacting solvency and regulatory compliance. Careful judgment is required to ensure that the pursuit of growth does not compromise the insurer's ability to meet its obligations to all policyholders. The correct approach involves a comprehensive, forward-looking assessment of the new business's impact on the existing portfolio's risk concentration, capital requirements, and overall diversification. This includes stress testing the portfolio under various adverse scenarios to understand potential capital erosion. This aligns with regulatory expectations for prudent risk management and capital adequacy, ensuring that the insurer maintains sufficient resources to absorb unexpected losses and remain solvent. It reflects a commitment to the long-term sustainability of the business and the protection of policyholders, which are core ethical and regulatory duties. An incorrect approach that focuses solely on the potential profit of the new business without considering its impact on portfolio diversification and risk concentration would be professionally unacceptable. This failure to consider aggregate risk could lead to an overexposure to a particular industry or peril, violating principles of sound underwriting, and potentially breaching regulatory requirements related to risk diversification and solvency. Another incorrect approach that involves deferring a full risk assessment until the new business line has been established would also be a significant failure. This reactive stance ignores the proactive risk management principles mandated by regulators and ethical underwriting standards. It exposes the insurer to unknown and unmanaged risks, increasing the likelihood of unexpected losses and potential regulatory intervention. Finally, an approach that prioritizes meeting short-term growth targets over robust risk assessment would be detrimental. While growth is important, it must be achieved within a framework of controlled risk-taking. Ignoring or downplaying risks to achieve immediate financial gains can lead to long-term instability and a breach of fiduciary duty to policyholders and shareholders. The professional decision-making process for similar situations should involve a structured risk assessment framework. This includes identifying all relevant risks associated with the new business, quantifying their potential impact on the existing portfolio, and evaluating the adequacy of existing controls and capital. Underwriters should consult with risk management and actuarial teams to ensure a holistic view. Regulatory guidance on risk appetite, capital adequacy, and portfolio diversification should be a primary consideration throughout the decision-making process. Question 20. Stakeholder feedback indicates that a long-standing, high-revenue client is experiencing a temporary downturn in profitability due to external market factors, but their loan repayment history is impeccable. The underwriter is tasked with regrading the loan, Which of the following approaches best aligns with regulatory expectations for loan grading and classification? Option A. Assign a lower loan grade based on the current profitability dip, while acknowledging the client's relationship and historical performance in the commentary. Option B. Assign a lower loan grade based on the current profitability dip, but recommend a concessionary interest rate to offset the perceived increased risk. Option C. Assign a lower loan grade based on the current profitability dip, without significant consideration for the client's relationship or historical repayment record. Option D. Maintain the existing loan grade, emphasizing the client's strong relationship and historical repayment record as mitigating factors for the current profitability decline. The correct answer is A. Assign a lower loan grade based on the current profitability dip, while acknowledging the client's relationship and historical performance in the commentary. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need for accurate loan grading with the potential for subjective interpretation and the pressure to maintain business relationships. The core difficulty lies in applying objective grading criteria consistently when faced with qualitative information and the implicit expectation of leniency. Careful judgment is essential to ensure regulatory compliance and sound risk management without alienating key stakeholders. The correct approach involves a rigorous, data-driven assessment of the borrower's financial health and repayment capacity, strictly adhering to the established loan grading matrix and internal policies. This approach is right because it prioritizes objective risk assessment, which is the cornerstone of sound underwriting and a fundamental regulatory expectation. By focusing on quantifiable metrics and documented evidence of financial performance, the underwriter upholds the integrity of the loan portfolio and mitigates the risk of future defaults. This aligns with regulatory frameworks that mandate prudent lending practices and accurate risk classification to ensure the stability of the financial institution and the broader financial system. An incorrect approach would be to rely heavily on the borrower's long-standing relationship with the bank and the assurance of future business to justify a more favorable loan grade than the financial data supports. This is professionally unacceptable because it introduces subjectivity and bias, undermining the objective risk assessment process. It creates a conflict of interest, where commercial considerations override prudent underwriting principles, potentially leading to misclassification of risk and an inflated loan portfolio. This directly contravenes regulatory requirements for objective risk assessment and prudent lending. Another incorrect approach would be to defer the decision to a senior manager without providing a clear, data-backed recommendation based on the established grading criteria. While seeking guidance is sometimes appropriate, abdicating the responsibility for an objective assessment based on the available information is a failure to exercise professional judgment. It suggests an unwillingness to apply the established rules or a lack of confidence in one's own assessment, which can lead to inconsistent application of policies and a weakening of the underwriting function. The professional decision-making process for similar situations should involve a systematic review of all available financial data against the defined loan grading criteria. The underwriter must document their assessment thoroughly, clearly articulating how the borrower's financial position aligns with or deviates from each grading factor. If there are ambiguities or qualitative factors that warrant consideration, these should be explicitly identified, and their potential impact on the risk assessment discussed, always within the bounds of the established policy. The underwriter should be prepared to defend their recommendation with objective evidence and to escalate concerns or seek clarification on policy application, rather than compromising on the integrity of the grading process.